Hello, everyone. This is Philip Nelson here to kind of run through our third quarter market outlook webinar. So happy that you're able to join us, and we're gonna be running through this relatively quick. Got a lot to cover. We know it's a busy schedule these days in terms of October's always a busy month. We've got an election right around the corner, and holidays are fast approaching. But joining me today is Chris Levell, a partner at NEPC, also a member of the asset allocation team, who's going to spend some time to provide an election overview for the next few weeks of what we're likely to see for the U.S. elections. So just as we get started, we want to talk a little bit about what we've seen in the markets for this last quarter and maybe even for the last several months, and also how that reinforces some of our key themes and kind of views on the big key market themes that we've identified and discussed in prior webinars. But first, when we just look at what have we seen in terms of performance, I think we all know this, but risk assets for the quarter was another really strong quarter. U.S. emerging markets led the way. We still see some laggards for the year, especially in the commodity sector. Smaller companies, non-U.S. developed, but broadly we're seeing a broad recovery across many asset classes, and to some degree that's continued a bit into the third quarter, notwithstanding the last few days. We're going to spend a little time and just kind of dig into a little bit of what are the main drivers of the markets. And I think many of you know this, and I think we all kind of experience this and feel this on a day-to-day. But the main drivers really have been kind of a small select number of stocks. When we look at the U.S. equity market, we look at Facebook, Amazon, Apple, Microsoft, Netflix, whatever clever acronym you wanna attach to those names. Really, it is a massive contribution to stock market performance that we've seen from these names. And just since kind of the lows in March, or kind of the height of kind of pandemic concerns for the market, we've added almost $3 trillion in market cap to those names. And when you look at these tech names in the U.S. and compare it to other broad kind of equity asset classes, you could argue it's an asset class unto itself. It's over $7 trillion in size. Really, the only comparison is the entire market cap of Europe itself, which is really a fascinating dynamic in terms of how much the technology sector has been a big driver for equity performance. And when we look at outside the U.S., especially for this last quarter, we see really strong performance out of the emerging markets, and specifically that's coming from Asia. In many ways, whether it's South Korea, China, Taiwan, they seem to have recovered more quickly and weathered some of the economic dislocations associated with COVID better than other countries. And you're starting to see that kind of come through both in economic data, but also importantly in terms of stock market performance. I think what's an interesting data point relative to kind of the Asia equity story is that these are also very much technology heavy sectors. And so you're seeing that again, kind of similar dynamic in the US, maybe not to the same scale. You're seeing that emerging markets where technology is again a driver for many of the gains that we're seeing today. And what's interesting in some ways when you think about what's the main driver of technology, it's in some ways you could argue it's discounting of future earnings. And so what is earnings multiples for tech names 5 years out, 10 years now? And that kind of valuation is obviously pushed higher as interest rates stay lower. This is kind of a silly and simple chart, and really just kind of focus your eyes on the bottom two lines. The dark blue is what the market says Fed funds futures will be for the next 3 years, somewhere hovering around zero, with some flirtation of below zero and negative. And what the Fed has said they expect rates to be for the next 3 years. So it's hard to argue with both policymakers and markets when they're saying interest rates are going to stay low for the foreseeable future. And we expect this dynamic to continue, provide some stability to the market, and also benefits kind of higher PE tech names, reinforcing that trend. And you see this in fixed income markets today. So as we look at kind of safe haven securities, as we call it, whether it's a 10-year treasury or 10-year TIPS, you can see that yields have touched all-time lows. And in many ways, we expect them to kind of be anchored here for the foreseeable future, as long as the Fed's continuing to support low interest rates, and we don't see big spikes in inflation. So both of those seem relatively unlikely from kind of a probability weighted kind of scenario, which again reinforces, we think, is the need for having some of these safe haven fixed income exposures on a go-forward basis. And one of the interesting other dynamics that's at play here is with low interest rates, with the encouragement from central banks and kind of fiscal support, is the dramatic uptick in corporate bond issuance we've seen in the U.S. We're on pace to set all-time records for calendar year 2020 in terms of corporate bond issuance, which is not a surprise that they're taking advantage of these all-time low rates. But when you think about prior economic recessions, economic dislocations, you generally don't associate those with all-time issuance levels from corporations. And this kind of dynamic is one that highlights some of the key themes that we have that we believe are in place for the markets today. And we've talked about our key themes in the past of how we think they influence global markets and can really be relevant for a prolonged period of time. And we focus on 4 key themes: China transitions, globalization backlash, virus trajectory, and permanent interventions. Now, we'll only focus on 2 of them today, one related to the virus and 2 related to permanent interventions. And we think these are the kind of macro forces that are the dominant drivers in market pricing. And many of the data points I just mentioned are kind of reinforced by these 2 themes. And so when we think about kind of virus trajectory and how that aligns with kind of the economic risks we see today, as we've moved from kind of lows in the March to concerns in June of what's the path of the pandemic to where we are today, it seems very much more likely we're in the kind of quote K-shaped recovery, where we're seeing almost 2 disparate paths for the economy. One, a la corporate America, where you're seeing debt issuance and for some companies profits actually up, and the other for smaller businesses, it's a very tough go of things. And as we think about how do these economic factors impact the market, and more importantly, how do we balance kind of the market sentiment when on one side we have optimism over a potential vaccine, and then on the other side, where we're seeing even today kind of uptick in prevalence, could we see additional kind of social distancing measures and kind of economic lockdowns, especially in U.S. and Europe? It's always hard to try to encapsulate kind of economic dislocation in just one chart, especially with the pandemic affecting such a broad area of the global economy. We thought this was an interesting point to highlight. And this comes from Yelp, which they've actually developed a local economic impact report that highlights business closures over the last 6 months. And what you see is kind of, as we expected, kind of both a kind of temporary shuttering of many businesses, but also many of those have not come back. And so at this point, we've seen nearly 100,000 businesses close, according to Yelp. 150,000 remain closed, hopefully temporarily. And we think about how that impacts spending, how that impacts kind of investor behavior, how much small businesses drive job growth in the United States. Clearly, that kind of highlights the kind of heights of dislocation we're seeing today. And also, it explains what we're seeing from central banks. A theme you've heard us talk about before is permanent interventions. This idea that central banks and fiscal policy makers will do whatever it takes to support the economy. And what we're seeing here is the Fed and frankly other central bankers do whatever is necessary to essentially ensure that the financial markets continue. Our expectation is policymakers will eventually do whatever it takes to pass fiscal stimulus, but political risk is one that's more real in this country that's been in prior decades, and it may take longer for us to see stimulus dollars come into the U.S. economy, but one that we do think will definitely happen at some point. And Chris will get in a little bit some of the political dynamics at play with the election update in a few minutes. And so with kind of the market backdrop, the key themes that we're seeing today, in some ways we've really kind of gone gone to a back to basics approach and simplified our thoughts and tried to be as clear and succinct as possible. I think one of the things is that we're fully aware of, let's be aware of our own ignorance. And when we look at the next couple of years, it's going to be incredibly difficult to be clear where the market path will be and where economies, how they recover, when they recover, and how quickly. And so when we think about, the uncertainty of the next 18 months, let's go back to kind of true objectives, strategic focus, and really focus on kind of things that drive portfolios over the long term. And so with that, really encouraging, staying disciplined to your strategic targets, making sure portfolio liquidity levels are kind of at appropriate levels for all your spending needs. Then thinking about, how can we go on offense in what is kind of a very difficult market environment at times. And we think this permanent intervention theme is one that can actually sustain risk asset sentiment for the foreseeable future. And long-term may actually kind of be a benefit to equities. And so within some of the, market dynamics that we see, we have a favorable view from a strategic standpoint to U.S. equities and emerging markets relative to kind of quote a global equity index of MSCI ACWI. Then also we think about, we're likely to see some challenging market regimes. And for some, things that we view as kind of quote diversifiers, such as multi-asset strategies and other types of, diversifying inputs in a portfolio, may see some challenges. And so we may need to reassess the role of those type of approaches in portfolios today. And just to kind of hammer home a message of kind of importance is our view of safe haven fixed income. When we look at, making sure you have adequate liquidity levels, how do you mitigate kind of economic dislocations? How do you provide a kind of true diversifier, let's say, to equities? We look at treasuries as being that primary choice. And kind of on a go-forward basis, we think a blend of treasuries and TIPS is appropriate for most total return investors. I think that's probably the best combination of safe haven exposure to deal with changes both in nominal rates and real interest rates. And with that kind of long-term view, kind of just two quick points I want to highlight. Just look at the line item for global equity here. 10-year return assumption. This is rolled up for kind of a MSCI ACWI, 6.5% return expectation. And we look at treasuries. Treasuries are 60 basis points. And so as a something to emphasize, we're not emphasizing safe haven by any means as a return driver, solely there as a liquidity provider and to kind of make sure you have the appropriate level of kind of defensive ballast in the portfolio. But when we think about that large of a differential, start thinking about, should my equity targets be higher? Let's look past year 1, year 2, year 3, think 10 years out. Do I need more equities in my portfolio to beat my return objectives? And so those are some of the conversations we're having today in regards to structuring portfolios and thinking in a kind of strategic fashion. And so just before I finish and hand it over to Chris, just to highlight a couple items where, clearly uncertainty is high, and investing in that type of environment is hard, but, reinforcing that, there's a wide range of outcomes we could see associated with the COVID pandemic. And having a dedicated allocation to treasuries, can really provide that downside protection, serve as a area of liquidity for the portfolio. And at the same time, some of these dynamics are at play in terms of Fed, keeping interest rates low, the fiscal response to provide as much, money as possible in terms of the economy and folks' pockets can really help sustain a regime of low interest rates, but also drive PE ratios higher than they've been today. Maybe they've been in kind of in a secular sense over the last, 25, 30 years. So what is an easy segue talking about, investment world of uncertainty, I'll hand it over to Chris to provide kind of an update on our election outlook.
Thanks, Phil. This is a interesting time to be talking about an election because we're just 1 week away from the U.S. elections. If you'd like to get a little bit more information than I'm going to go through quickly here, Jen Appel and I did do a longer version, longer presentation of our views on the elections. We've updated some of those slides, but in general, this is a summary of those. And in point of fact, we do plan once again to do a webinar after the election. I think the challenge this year is, as you'll hear, we're not sure if we're going to have clarity, the day after the election, or more likely a week after the election. So stay tuned for when that election wrap up is going to be. And so some of these speculations here will be known in the next couple weeks. So we can turn to the next slide. The fundamental things that I'd like to leave you with in terms of NEPC views on the election is, firstly, is Phil's already gone through. We think that the permanent interventions theme is just extremely powerful in the markets. And the Federal Reserve remains in the driver's seat as to what we'll see in capital markets. And one way to think about this is when there is a loss of sentiment in the market since the COVID crisis began, the Fed has stepped in to provide liquidity, to provide stimulus. We've had some fiscal stimulus, but certainly more around the world than in the US. And in that regard, bad news can equal good news in terms of the amount of liquidity that's available. So the first key point, the Fed, we think, is still most important. Second key point, yes, the presidential election is important, and a lot of this will focus on that. However, what happens to control of the US House and Senate is pretty important here. If there is a divided government of the various forms that could happen, that's going to really limit the ability of the president to advance an agenda. We recognize that there's a lot of stress, there's a lot of political division this year in the midst of having pandemics and lockdowns. But we think, actually, because of that first point in the Federal Reserve, if there is a big drop in risk assets over the course of the next several weeks and months, that could actually end up being a buying opportunity, because we think the ground is set for the economy to chug along because of all the stimulus. And Phil's already discussed, really what we think is important is keeping to the core objectives. Turning to the next page now, diving a little bit deeper into the markets. We did have a recession this year, and generally recessions are very bad for incumbent presidents and incumbent parties. You'll see here, this is actually going back 120 years, but over the last 100 years, we've had these seven times when there was a recession in the year of a presidential election, and only one time did the incumbent party, in this case the incumbent president, win, with Harry Truman in 1948. You'll notice that the months into the recession was zero, so people were feeling the angst at that time, but they didn't actually get the official word they were in a recession. Nevertheless, it was an extremely close election. We looked at this and say, absent the odd nature of having a episodic recession from a pandemic, that's generally bad for the incumbent. On the next page, here's a look at the electoral map. There's an interesting website called 270 to Win that aggregates polling data, aggregates prediction markets data, and also allows individuals to just go on the site and look to what they think could happen. As you probably know, in the US Electoral College, you need 270 electors to be elected president. And what we've done here is just taken the consensus from 270 to Win and then carved out what we've identified as battleground states when we first looked at this. Those are actually in gold here. So you see dark blue and lighter shades of blue with expected wins by Biden and the Democratic Party, and the red and pinkish color for Trump. At least in this view, there is, with these swing states, the chance for it to go either way. And certainly that's what happened in the last election, where key states turned late into the night of election day. As we'll mention, we don't think it's going to go quite like that. But turning to the next page, here are the battleground states, and I think one of the key takeaways also that we'd like you to have, and this has been in the news because there have actually been two Supreme Court rulings in the past week on some issues around these states. So each state has rules about how it will receive absentee and mail-in ballots. And you'll see that some of them on our list of battleground states here have to have the ballot received by November 3rd. So in other words, you can vote absentee or mail-in at any time, but it has to get into the polling place on the day of the election to be counted with all the other votes. There's actually a Supreme Court challenge that went up to the Supreme Court yesterday that affirmed that all Wisconsin ballots need to be in by November 3rd. But you also see in other cases, another Supreme Court case was in Pennsylvania. You can be in later, and in fact, the latest on this page is Ohio, where your ballot has to be postmarked by Election Day on the 3rd, but it can be received up to 10 days later. The reason this is important is we know that individual states can become fundamental swing states, and election will depend upon what happens in any of these particular states. If that's the case, for example, in Ohio, if Ohio going one way or the other decides the presidential election, we really won't be able to know with certainty the winner until November 13th or 14th. And so that makes this year, quite a bit different than past years. But we do have a bit of a historical analog on the next page. You'll recall that in the 2000 election, Florida happened to be the state that really the entire election hinged upon which candidate, Bush or Gore, won in Florida. And it was deemed too close to call on election day. And so what this chart is showing you is actually what happened to the S&P 500 on the day starting of the election until at the end of the graph you see there when Gore conceded and the electors voted to elect Bush. You see the various things along the way. I always think about the Palm Beach having hanging chads and whether those should be considered real votes or not. Just a lot of volatility, involvement by state courts and on up to the Supreme Court. I'm not saying that this is what is going to happen in this election, but we have an analog for how uncertainty in the presidential election can play out in real time in financial markets. One additional point I wanted to make, maybe Phil, if you could go back to the map up. I mentioned up front how important the Senate races are, and this obviously just reflects the electoral votes and what's happening for the presidential race. But you can look at similar maps for the Senate elections. Generally, if you look at polls or if you look at prediction markets, it's highly anticipated. So the most likely outcome of the three branches, the three different elections here we're talking about, is that the House of Representatives will remain Democratic. So that has very high polling data, experts looking at that. The next most likely outcome of the three major elections is Biden winning the presidency. And so the one that's actually, we think, highly determinant is into what the next 4 years mean in terms of governance is what happens in the Senate, where the Republicans currently have a majority, but through times in the last few months have been thought very likely to lose enough seats to the Democrats such that Democrats would have control of all three houses, a so-called blue wave. In looking at the map and looking at the individual Senate races, there's a lot of uncertainty just going into a week before the election. And it could be that what happens in the Senate actually becomes the thing that we're waiting on going on into the middle of November that really determines, like I said, what the next 4 years could mean. With that, we recognize it makes sense to look at what this could actually mean for markets. And just a few key charts here. We're basing this on the policy documents released by the candidates. I think those generally need to be taken with a grain of salt because history has shown us that what the policy is running and what the policy is governing is usually a little bit different. But we expect some differences in things like tax policy. So President Trump has campaigned on maintaining and extending the tax cut from 2017, whereas the Biden campaign is looking for those to expire and perhaps have some additional taxes on corporations and on high earning individuals. So that would be an area we definitely expect to see differences between them, but also dependent upon who controls the Senate. The next slide, we have US-China relations, and I think this is very different than even how it was just 4 years ago in 2016. When candidate Trump 4 years ago came in with a strong anti-China stance in trade, that was seen as outside the mainstream. And you'll notice in the chart in the lower right, this is looking at voters' view of unfavorability of China. And you've seen that go up for both Republicans and Democrats, and actually really not that different. So we have not seen the Biden campaign really talk about we need to get back to the trade deals that we've had with China in the past. This is an issue that we actually think is one that's fairly bipartisan at this point. And then the final point on the markets on the next slide is just looking at the regulatory policy. We do think, again, this is a big difference between the candidates and between the parties. The Trump administration was able, being in the executive office, to really reduce the number of regulatory actions and generally wanted to see more rules reduced rather than seeing new rules put in place. And this has been a big issue for certain segments of the Democratic base, wanting to see more regulations. Certainly in the area of fossil fuels, we've seen quite a bit of conversation in the last week going into the election. So in summary, this is the repeat of what we've said, but that's always helpful. We do think that the Federal Reserve is really important here. And one of the interesting things I mentioned that in a Biden presidency, the markets do expect to see higher taxes and more regulations, which I think you'd naturally say, well, that's actually bad for businesses and that should hurt the stock market. There are several folks on Wall Street coming out and saying actually a blue wave would be very strong for the markets. And one of the reasons they're saying is they would expect greater fiscal stimulus going along with this permanent interventions theme from what the Fed is doing. So that's we think the really key observation here. The divided government will be important, and this, as I've said a couple times, this may come down to finding out whatever the last Senate race is and whether to see which party controls the election. I've already mentioned, the differences between a Trump and a Biden presidency and these differences in the Senate. But we do expect to see some volatility around this, especially if the outcome of the presidency and or important Senate races are in doubt and drag on, a week, 10 days or more. But as I said, we will follow up with a webinar once there's more certainty about this, and hopefully many of the things we discussed here today will inform the things that we say at that point.
Great, thank you, Chris. And as Chris said, there's a webinar we're planning post-election to cover. Hopefully, we'll know the results, and on top of that, what more detailed breakdown of our election thoughts. You can find a webinar that Chris and Jenna Pell recorded earlier this month on the topic. I think I'm sure I share the sentiment involved. We just want more election content as much as possible. And so with that, why don't we take a couple minutes for questions, and just give a moment just to see if there's anything in the system. And one that did come up is in regards to our outlook on safe haven bonds and how inflation outlook might interact with that. some of the concerns we've heard of there is, is there a risk of failed treasury auctions because issuance is so high, or inflation will tick up? And I'd say there's kind of two areas that we'd point to. One is not always the best example to use, but when we look to Japan in terms of what Japan has done for monetary policy, their debt issuance has been quite high, even higher than what we've seen in the U.S. And frankly, the central bank has stepped in to kind of be the buyer of the majority share of issuance there. And we'd expect the same type of dynamic from the Fed. So in many ways, Fed will be the source in the kind of a virtuous relationship between policymakers and the Fed to kind of absorb the new debt issuance that we expect. Then on the inflation side, we look at what our outlook is, and I think in some ways we've taken an approach of let's have data points that highlight that inflation is rising, and that's not something we're seeing today. The risk that's kind of least discounted by the market, it's the lower probability risk, but the one that would be the most surprised would frankly be inflation rising. But there's very few data points that we see that highlight that. And on top of that, when we think about the technology changes, the demographic headwinds, we're of the view that inflation will be relatively neutral. And in terms of the election piece, real quick, Chris, if you have a moment, could you just give reiterate kind of thoughts on how maybe both a Biden administration would be able to kind of set policy, or a Trump administration would be able to set policy, depending on who would be having control of the Senate?
Sure. So, I think a lot of speculation in the last few weeks, just based upon polling, was anticipating a so-called blue wave with Biden winning, certainly the House maintaining staying Democratic, and also the Senate going Democratic, or even tying, in which case Kamala Harris would be presiding over the Senate and would be the 51st vote. In that case, we would expect quite a bit of stimulus. There was actually the HEROES Act passed by the House, but not by the Senate. That was a second round of stimulus after the CARES Act. We would expect, similar type of legislation with, multi-trillion type levels of stimulus to come in that blue wave. And that's part of what I said with this being viewed by Wall Street as very favorable in the short term for really a huge, once again, unprecedented amount of stimulus. If Biden wins, but the Republicans maintain the Senate, I think it's very similar to the second term under Obama, where not a lot of legislation would get through, not a lot of bipartisanship, and I guess it remains to be seen with how much vitriol there has been and partisanship, would getting past this into a new president, would that make things more amenable? It's hard to imagine right now for me in 2020, but that's a possibility. But anyway, I think less. If Trump wins and maintains the Senate, well, that's pretty much what we've had the last 4 years. So partisanship, but probably some limited amount of stimulus, and then probably the least likely outcome, a Trump win, but a Democratic Senate. I think that's just that would not be fun from a partisan standpoint, or just from a daily news or Twitter standpoint, what that could mean, because I don't think a lot would happen.
Great, thanks, Chris. And the last question we had was kind of in regards to our investment outlook and some of the changes we're seeing folks make with portfolios on a strategic basis. And I think one of the things that we have seen, and kind of mentioned this earlier, is because of that permanent intervention theme that we talked about, where interest rates stay low, maybe equity valuations trend higher. That's something we can see, occur for kind of a prolonged period of time. Encouraging folks to think about higher equity targets, and with that probably requires some changes for portfolios, and things that we classically would have thought of as diversifiers, let's say, may not be able to perform that kind of same diversification function in that type of market environment. And so some of those approaches may be what's used to kind of help fund, some equity allocations depending on each, individual circumstances, but also, shore up some liquidity with an enhanced safe haven fixed income exposure. And I think the drawback to there's no free lunch. The drawback is probably slightly less diversified, and potentially exposed to, should we see inflation rise dramatically, I think much of the market today is ill prepared for that. I think that's just a risk scenario, economic scenario basis that we all need to kind of be aware of and account for when we kind of look at kind of what of our kind of loss testing and kind of portfolio stress tests we need to make. So with that, wanted to thank everybody for joining. As I mentioned, you can get more election updates, overview on our website, webinar coming following the election. This presentation will also be posted on our website, which you can all find at NEPC Insights. And again, thank you all for joining us, and encourage you all to go vote over the next week. And thank you all, and have a great afternoon.